All right, welcome to today's Explainer. We're putting on our investigative analyst hats today to literally rip apart PPL Corporation's financial statements. We're going to strip away all that mainstream media hype and look strictly at the raw data.
Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
So the financial media has been absolutely obsessed with PPI lately, right? On one hand, you've got this somewhat disappointing Q2 earnings miss, but on the other, there's this incredibly flashy new narrative about AI data centers. So we really need to figure out, is PPI a misunderstood AI data center play that's about to absolutely take off? Or is it just an overvalued utility trap? Well, today, we're letting the balance sheet do the talking.
Let's kick things off with Section 1, the macro reality.
Let's look at the context of their Q2 earnings, because honestly, the market reaction here was completely counterintuitive. PPL reported Q2 ongoing earnings per share of 33 cents. That missed the Wall Street consensus of 37 cents, so roughly a 10.8% miss. Top-line revenue came in at $2.11 billion, missing the forecast by a solid $80 million. Now, in a normal environment, a top and bottom line miss like that sends a utility stock straight to the basement. But astonishingly, the stock actually climbed 2.5% to $35.49 following the news. Why? Well, the market is basically booing the stock on the massive hype surrounding their Invadium Energy joint venture with Blackstone, which is supposed to serve this massive new data center load. Investors are literally looking right past the current quarter's miss.
Which brings us to Section 2, the valuation gauntlet.
We are running PPL through the ultimate valuation gauntlet, testing the hard metrics we can extract directly from their latest filings. Diving into our dividend and comparable models, the expense of this regulated utility becomes glaringly obvious. A trailing price-to-earnings ratio of 21.2, that stands out immediately. A price-to-sales multiple of almost 2.85 is also incredibly high for a traditional power provider. With the stock trading at $35.49 and a book value of just $20.26, you're paying a hefty 1.76 price-to-book premium. The one saving grace here for income investors is that 3.21% dividend yield, which is safety covered by a 68.1% payout ratio. But strictly on multiples, you are paying a massive premium. Even when we factor in our discounted cash flow models, assuming standard weighted average cost of capital and unlevered free cash flow, the intrinsic value hovers around a much lower $27 per share. That means the market is heavily pricing in future growth.
Turning to the asset-based models, PPL does boast a massive total asset base of $46.3 billion. But here's the catch. That is weighed down by $19 billion in long-term debt, compared to just $12.3 billion in total equity. That heavy debt load drags down the net asset value, and frankly, it becomes a very real drain on profitability in a higher interest rate environment like we're in now. Now, if we run advanced options models, specifically applying Black-Scholes logic to value their future pipeline expansion projects, it does add some real options premium to their valuation. But honestly, it's still not enough to comfortably bridge the gap to that $35 trading price.
All right, Section 3, the 7+7 media blackout flags.
We're going to look at the red and green flags buried deep in the footnotes that the mainstream media completely ignores. First up, the 7 red flags. We already talked about the 10.8% EPS miss, which gets glossed over by pundits who are entirely focused on future AI narratives. Same goes for the $80 million revenue miss. It just ruins their perfect growth story, right? Third, margins are actively being squeezed by higher depreciation and interest. That's a metric often ignored because, well, it requires actually digging into the depreciation schedules. Fourth, quantitative models like Investing Pro's fair value calculator actively flag the stock as overvalued, directly contradicting the AI hype. Fifth, that flashy Invadium joint venture, it requires massive capital expenditure with literally zero earnings for years, a reality TV pundit skip for a quick soundbite. Sixth, you've got an uninspiring trailing return on equity of just 8.6%, which gets buried because it's not a fun top-line number. And finally, that $19 billion debt load is massive, but complex capital structures rarely make the evening news.
But let's flip it and look at the 7 overlooked green flags to build a counterargument. First, management reaffirmed 2026 full-year EPS guidance of $1.90 to $1.98.
It's a boring but absolutely crucial steady-state indicator the media overlooks. Second, 56 consecutive years of dividends paid. That is an insane reliability streak overshadowed by tech growth stories. Third, they're executing a massive $33 billion capital deployment plan through 2029, ignored mostly because long-term CapEx modeling is just tedious. Fourth, their coal reliance is rapidly declining to below 12% by 2027, a major ESG shift completely lost in the AI noise. Fifth, and this is huge, a massive 32-gigawatt data center pipeline in Pennsylvania. You'd easily miss that if you only read headline earnings. Sixth, a 6.3% rate-based compound annual growth rate through 2027, which requires reading footnote projections. And seventh, top-tier credit ratings from Moody's and S&P, which stock jockeys routinely ignore in favor of equity momentum.
Moving on to Section 4, Legendary Investors Reality Check. Let's do a reality check and see how the absolute titans of finance would view this setup. We'll start with the father of value investing, Ben Graham. His famous formula takes the square root of 22.5 multiplied by the trailing EPS of $1.68 and the book value per share of $20.26. That spits out a strict intrinsic Graham number of $27.67 per share. With the stock up around $35.49, PPL completely fails Graham's test. It is undeniably overvalued. What about the growth at a reasonable price legend, Peter Lynch? Well, he uses the PEG ratio. If we divide the PE of 21.2 by their target historical growth rate of about 7%, we get a PEG ratio of 3.02. In Lynch's book, anything over 1.0 is too expensive, so that's a hard pass from both Graham and Lynch.
So what about the Oracle of Omaha, Warren Buffett? You know he looks for wonderful companies at fair prices, heavily relying on a consistent return on equity greater than 15%. As we just saw, PPL's ROE sits at a lackluster 8.6%. It completely fails his core profitability hurdle for a high-quality compounder. The really crucial point here is that right now the market reality is completely decoupled from these traditional, legendary metrics. A 21.2 PE ratio proves the market is pricing in all that future AI and data center growth today, willfully ignoring the sluggish current return profiles.
Finally, Section 5, Moat and Synthesis, and our final verdict. First up, let's evaluate their capital investment plan and economic moat. PPL's moat is deeply rooted in efficient scale and regulatory capture. Operating as a regulated monopoly in regions like Pennsylvania and Kentucky, they are making real, tangible investments in transmission and distribution. Because regulators allow them to earn a guaranteed return on these investments, this 6.3% rate-based growth directly translates to an expanding economic moat over the next 3 years. Synthesizing all our findings, we look first at valuation. Based on the average of all our models, the PE, price to book, discounted cash flow, and Graham's formula, PPL Corporation is fundamentally overvalued right now. That $35.49 price tag is significantly higher than its roughly $27 intrinsic value. But moving to the economic moat, despite the rich price, this business is incredibly well defended. Operating as a regulated monopoly, its moat is actively expanding through 2027, driven by massive infrastructure investments and positive rate case momentum across its service territories. So what's the nuanced takeaway? You absolutely must recognize what you are buying here. PPL is inherently a slow-growing utility, but right now the market has priced it like a tech-adjacent AI stock purely because of that 32-gigawatt data center pipeline.
And that brings us to the ultimate question. The strict quantitative models are screaming that this stock is overvalued, but those hidden green flags regarding the AI data center runway, they suggest massive long-term transformational growth that traditional formulas just can't measure. A storm of capital expenditure and grid demand is coming. So which side of the fence are you on? Are you trusting the historical math, or are you buying the grid of the future? Do your own homework, dig into those 10K filings, and thanks for joining us on this explainer.